Welcome back, students who are taking financial accounting, and in this series of videos we were working on the assigned homework problems from the digital study guide for chapter 8, the short exercises. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that's a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Okay, so we're kind of like almost done with the short exercises here. So yeah, we're on 16, so we only have 16 and 17 to go. All right, so they'll both be covered in this video and we'll be done with the short exercises. All right, let's see here. Other long-term assets. Classify each of the following as a trading security, available for sale security, held to maturity security, or none of the above. Okay. Remember, these would be considered, even though they're calling them long-term assets, marketable securities. A trading security would be a marketable security. Okay, so they're calling them long-term assets. I call them other assets. Okay, because why? Cash on your chart of accounts or on your balance sheet, you'll have cash, petty cash, and then marketable securities next, right, before accounts receivable. And so other assets, these would be considered another asset as a marketable security. Long-term assets would come after, like property, plant, and equipment, okay, and that would include things like land. Right. So go back and watch the theory videos on that, right? But anyway, a bond that management plans on owning until it is repaid. Management does not believe it will need to sell the bond to generate cash before the bond's scheduled maturity date. Okay, so they're holding that until maturity. So that would be held to maturity security. Because why? They won't need to sell the bond before the bond's scheduled maturity date. Land that management is holding as an investment. Well, these aren't securities, so that's none of above. Land is not a security. Intel stock that the company management plans on selling quickly as soon as its price is 10% more than what the company paid at the time of the purchase. So that's a trading security because they're looking to buy it and sell it real quick. Basically doing the same thing as you buying stock in the stock market. Different companies will buy, if they have excess cash, they want a return on their investment for that cash, so they will buy stock in order to make a return on that money in the short term. Right, Ford Motor Company stock. Management does not actively manage the stock and intends to sell it only if it needs to generate cash. So that would be considered an available for sale security, right? They're not planning on trading it real quick. So it's an available for sale, meaning they're able to buy it and they're just going to sit on it, and if they need it, that's when they'll sell it. So that's why they call it an available for sale versus the trading security, which they're looking for that short, quick, let me make a profit and get out kind of thing. For Ford Motor Company, like for this company's stock, they're going to sit on it and they believe in that company thinking that it will go up, right? And it's funny because I am thinking in the back of my mind, which just happened during the course of the end of last year, this year, I think. If you go back and you look at a Ford Motor Company chart, I think the ticker symbol is just plain F. It was trading at like $4, okay? And they got a new CEO, and quickly the price went up to $14. Okay, and so even though they could have been buying and selling here as a trading security, you could have just said, okay, I'm going to buy Ford Motor at $4 and sit on it and sit on it and sit on it because I know it's an undervalued company, and I do expect it to go up, and I don't need the cash, so I'll just sit and wait. And they could still be waiting here at $14, okay? But they have that, gain on that asset. So, but if they had decided to just buy and sell along the way, then that would be a trading security versus an available for sale security. Okay, enough of that. All right, a bond that management plans on owning until it is repaid. However, management believes it may have to sell the bond within the year in order to provide enough cash for operations. Okay, so that's an available for sale security, right? It's a bond. They plan on owning until it is repaid. Okay, but they might think that they have to sell it. So, they're not doing it in and out. They're, going to sit on it. Now, you can make the argument that this could be a held to maturity security, and that they plan on owning it until it is repaid, right? But they believe they may have to sell it. Okay, and if they have to sell it, it moves out of, they're not, even though their plan was to wait until it's repaid, they think they're going to have to sell it, so it moves out of the held to maturity and moves to the available for sale aspect, even though it's the same bond. Okay. Inventory that management tends to sell within the year. Inventory has nothing to do with securities. Okay, so that's not applicable. All right, so that's it for that particular problem. Really, just think of it from, these securities as a time duration kind of thing. Trading security, in and out, right? Available for sale when we need it, when needed. And then held to maturity, meaning wait until the term is completely done, right? We're just going to hold on it until we get to wherever, okay? Held to maturity securities generally have a tendency to be bonds. Available for sale, it could be a bond or stock, but it's more often stock. All right, bonds, when you buy bonds, because of the interest rates on bonds and they're so slow moving, they end up usually being held to maturity. And with the stock, they move quicker, and if you do well with the stock market, you can make more. And the same with the trading security, it's a stock. So even though available for sale generally could be both, more often it will be the stock, and then of course the held to maturity would be a bond. Okay, that's just to give you an idea. All right, last problem here. Specify how each of the following items would be reported in the financial statements of Cunningham Enterprises for its current fiscal year. Also specify the amount that would appear on the statement. Okay, so how each of the following would be reported in the financial statements and the amount that would be appear. Some items may be reported on more than one financial statement. In these cases, specify the amount that would appear on each statement. So they're using income statement, balance sheet, and of course equity. All right. So I'm just going to use I, B, and S. All right. I'm not going to IS. All right. But anyway. All right. So number one, Cunningham received $143 of dividends during the year on its stock. So if it's receiving dividend, that's revenue. So that's going to end up on the income statement in the amount of $143. At year end, Cunningham owned a $5,000 treasury bond. Okay, that would be a marketable security. All right, so that would show up on the balance sheet and would be for $5,000. Cunningham sold stock for $580 cash that had been held as an available for sale security. The stock had been purchased for $520 and hadn't changed in value until the time of its sale. So if it was purchased at $520 and they're selling it for $580, there is a gain on the sale of that security of $60, and that gain is reported on the income statement for $60. stock that Cunningham purchased for $875 during the year as an available for sale security has a market value of $940 at the year-end balance sheet date. Okay, so this here, it has a market value of $940, and they purchased it for $875. So the difference between the two is $65. Okay, now obviously there is a gain here. All right, so that gain is going to be shown on the income. Oops, no, it's not shown on the income statement. All right, let's back up here. All right, notice that for number 3, they're selling the stock. Okay, when they're selling the stock, that gain is reported on the income statement, and that income, right, eventually ends up in the retained earnings account, which is on the balance sheet, right? But notice up here it's telling us for a change in stockholders' equity. So you're not seeing the change in stockholders' equity until you actually close it out. When they sell the stock, it affects the income statement. But here, they're purchasing the they're purchasing the stock during the year as an available for sale security and has a market value at the year-end balance sheet, meaning they still own it. Okay, and what you have to do is reflect the current condition of all of your investments. So your balance sheet would end up showing $940 because that's the market value of that security, even though you bought it for $875, and the change in the stockholders' equity, all right, would end up being $65. You still own this, okay? Where this one you sold, and that's the difference between the two, okay? And that's why, if you're watching this and you saw me stuttering a little bit, thinking, I'm trying to think, okay, one, where am I at in this process, and 2, how am I going to explain it, all right? So to go back over it again, with number 3 here, okay, they're selling the stock for $580 in cash, okay? The stock had been purchased for $520 and hadn't changed in value until the time of its sale. So the difference ends up being a change in the income statement because it went on and off the books really, relatively quickly. Okay, so there's no difference in your balance sheet. The difference is you're recording the gain on the sale of that stock. But here for number 4, right, you're purchasing the stock at $875. And you still have it when you get to the end of the year. You haven't sold it. So at the end of the year, you have to, record the change in, that stock position. And since the value of the stock went to $940, you end up the change in the balance sheet would show that your stock would have $940, not the $875. And the difference between the $875 and the $940, the $65, would end up as a change in your stockholders' equity. Okay, which now remember, you're still holding on to that stock, so you still own this $940 of stock, right? When you go to sell it, then you're going to take it off of your books, okay? And of course, you would have the gain, and that would, whatever it is, and it would show up on your income statement at that point in time, okay? as I thought about it just at the moment, don't be, I mean, obviously you need to know this a little bit, but don't be so overly concerned with it. Accountants do, okay, and you'll when you get into intermediate accounting, you'll be going through all of this in minute detail as to how to record everything, as far as purchasing and selling from year to year to year, that type of thing. How to record the gains and losses. Just be aware, and I'm kind of like surprised they stuck it in here as an exercise, but it's kind of like good to know just to even begin. So store it in the back of your head that when you buy a stock, obviously, you buy and sell, you record the gain in that year. If you buy and hold, you have to record what the value is at the end of that accounting period. Okay, you have to always constantly adjust it. So even if you're buying a held to maturity, well, you wouldn't be a bond. If you're buying stock and you're holding it over several years, every year you're going to have to update the value of that stock. That's the best way to explain that. Okay. All right, number 5. Let's see. The stock that purchased for $6.40 during the year as a trading security had a market value of $6.55 at the year-end balance sheet. So this is very similar to number 4. Okay. So the balance sheet is going to show that it has $6.55, okay, because that's the market value at the end of the year, and you have a gain of $15. $6.55 less $6.40 is a gain of $15, and that is going to be on the income statement for $15, right? Because this is a trading security, that's why it ends up on the income statement instead of in the equity. The available for sale, the difference between 4 and 5, they're purchasing this as an available for sale security. That's why it ends up on this change in stockholders' equity. But because this is a trading security, it ends up on the income statement. Number 6, $280 of interest earned on a bond that Cunningham Enterprises purchased from the state of Washington. Okay, so that's interest earned, which just shows up on the income statement, and that's for $280. Okay, all right, so that's it. Again, if you don't understand something, definitely, for this particular exercise, you're not going to find too much of this about this in the book. Go ahead and watch it again. It wasn't covered in any theory videos. Okay, so watch this video again if you don't understand it. If you still have any questions, feel free to contact an instructor. But do realize that this idea of the recording of securities and stuff like that is more fully covered in intermediate accounting. So with that said, we're done with this series of videos on the short exercises, and I will see you for the exercise problems in the next video.